So welcome, Nic. Thanks so much for joining us today.
Thanks for having me.
So we seem to be moving into the exact economic environment that Bitcoin's earliest and most vocal advocates assumed would eventually occur, and where Bitcoin would thrive. Are we there yet?
You know, I don't think Bitcoin needs any particular circumstances to thrive. I certainly think that the world that we're in right now, where we have pretty rampant monetary experimentation from every major central bank, certainly suits Bitcoin very well. But I think Bitcoin would have grown up just fine regardless of the monetary environment, because it's so differentiated from the tools that exist, and it does something pretty unique anyway. So I don't think it actually needs any specific catalysts or conditions to grow into its full potential. That said, if you look at the world today, M2, that measure of the money supply in the US, is growing at something like 25% annualized. M1 is growing even faster. It looks like we've entered a new kind of political regime in the US where both parties agree that the debt should be monetized. There's no party of fiscal responsibility left. And we're entering this world where there's a political demand for handouts direct to individuals, financed by monetary issuance, as opposed to the traditional ways that things are financed. And it's not looking likely that the debt is ever going to decline here. So I think the way that the debt load is reduced is through devaluation. So mindful of all that, it certainly looks like we're in for a pretty rocky decade from a monetary perspective. So yeah, I mean, things couldn't be better for hard assets like gold and Bitcoin.
Mm-hmm. And what about the pace of development of the Bitcoin network? What do you think about that versus Ether? And are you seeing any innovations that excite you?
Yeah, I would say Bitcoin has a very different approach to development than Ethereum does. And that's totally deliberate. And I'm absolutely fine with that. I think most Bitcoiners are. The key thing is to not screw up the money. We're talking about right now $200 billion worth of people's savings, give or take. So making aggressive changes to that, potentially breaking changes, is not something that Bitcoin has really signed up for. And that is reflected in the core developers' hesitance to push through new changes, without full consensus. So the hesitance we're seeing around the Schnorr Taproot activation right now makes sense to me. I certainly hope that it doesn't take some of the timelines that are being proposed are pretty lengthy. So my wish is that we get it in under 12 months, but I completely understand that we're building a multi-decade project here. So, being extremely careful about new incremental changes and making sure no entity is being economically privileged through access to kind of the development team, that there's no preferential treatment, there's no corruption, basically. That's by far the most important thing. That's what allows the money to remain neutral. Now, if you compare that with Ethereum, they've gone for a very different trade-off. They have opted to have much faster innovation, a much more rapid pace of development, which also opens the door to effectively capture of the kind of core development teams by projects that need slight changes to the project, to the protocol. And that's not necessarily bad. It might mean that the Ethereum protocol is malleating to be more in line with what certain influential members of the community want. But it does open the opportunity, it creates the opportunity for potential sort of graft, corruption, handouts. For instance, any proof of work change would be a direct wealth transfer to whoever was most equipped to kind of monetize that change. And that's the thing that really concerns me. So I don't begrudge that of Ethereum. I think that's a specific trade-off that they make. But I wouldn't want that in Bitcoin, because there's only one Bitcoin. it has this amazing history and pedigree and brand, and we need to be extremely careful with that and make sure that we're stewarding it properly and not making too many breaking changes aggressively. So the pace of development is pretty much okay with me.
And let's talk about exchange infrastructure, because it's clearly better than it once was and has survived some recent stress tests reasonably well. And you wrote an article about efficient market hypothesis earlier this year, concluding you thought that the Bitcoin market was comparatively efficient. Is clearing really efficient enough yet?
Yeah, that's a fair question. The main point I was making in that article was that the Bitcoin market is fairly informationally efficient, which means that it incorporates new information into the price in a fairly rapid manner. I did say that there are constraints to that efficiency, and one of them is the market's ability to absorb capital in a timely manner. And the exchange infrastructure is one of those constraints for sure. There is still a lot of regulatory uncertainty in the US as to how exchanges should be regulated. There's no federal regulator for exchanges. And all of these exchanges, for the most part, are regulated by the states in a patchwork of different regimes. You have a bunch of, most of the real liquidity is offshore, which complicates the matter. So yeah, I would expect a lot more consolidation. I would expect a lot of these exchanges to get out of the business of custody and outsource that custody to third parties. BitGo, Fidelity Digital Assets, those are some of the kind of emerging big custodians.
And now the banks.
And the banks. Yeah, I mean, there are already banks in Switzerland that are empowered to do crypto custody. Clearly, there's one or more banks in the US that are asking the OCC if they can be custodians. You have the Wyoming SBDI initiative, which potentially will allow banks to operate on a full reserve basis and be crypto custodians. So we're definitely seeing the crypto industry like cross the threshold and meet up with the traditional financial sector, which is really exciting. It's something that we've expected to happen for a long time, but it seems to be happening now. So I think that can only be a good thing if you have entities that can clear trades both on the kind of with Federal Reserve base money with access to the Fed window, and can clear the crypto leg of settlements as well. I think that would be pretty powerful. That's obviously not something that every Bitcoin user is going to need, but it's just one of those incremental changes which makes the market much more efficient.
We agree. We've been waiting for the institutions for a while. And any weak spots you see if they should open the floodgates?
Yeah, that's a very good question. Having worked at one of those big financial institutions on a team that was looking at crypto, a lot of the questions there had to do with forks and potential protocol risks, which could undermine the infrastructure built on top of it, right? That's definitely something that a lot of these entities worry about. A lot of these custodians and exchanges will have a fork policy. I think network level attacks are probably not given the credit they're due in terms of potentially being significant sources of risk here. I don't even think we've really seen the potential for network level attacks explored that much. People just presume that Bitcoin is entirely safe. Bitcoin and other smaller assets, which are easier to attack. I think most of the big risks involve what, when some of these institutions move down the ladder and look at other crypto assets, I think there's significant risks which are understudied for smaller proof of work chains, for instance, for, interlocking smart contracts where you have this web of risk which isn't fully understood. Bitcoin is pretty ironclad at this point, but there still are questions. There's always the potential for a bug. We have a good amount of investment in oversight and kind of security analysis of Bitcoin, but it could always be more, relies on the work of open source contributors. So I'd love to see some of these larger financial institutions that touch Bitcoin start to contribute back to, you know, the couple dozen core developers that actually keep this thing running and keep it safe.
What about DeFi?
Anything specifically? It's just such a big topic.
Well, we're talking about security risk, but in general, there's been exponential growth the past few months. And I know that you really, try and steer away from investing there because of risk. Could you talk about that a little bit more?
Yeah, DeFi hasn't been a core part of our mandate as investors. We normally focus on corporate equity as our vehicle to get access to the industry, as opposed to tokens. So just structurally speaking, we're not very involved in DeFi. We obviously pay attention to it. In the last couple of weeks, it's become extremely frothy. I think that's evident to anybody on the sidelines. There's a lot of projects which have pretty extractive models, some which are effectively Ponzi's, unfortunately, that have yet to wind down. And I think we're going to see, the moment the enthusiasm for DeFi lapses, some of these higher profile and more marginal projects will wind down. There's a lot of leverage built up in the system, and a lot of these systems are built on positive feedback loops, which work great when things are on the way up and then are extremely bad on the way down. And I can give some examples. I don't want to be, too critical of any of these projects. But if you look at the way these things are valued, for instance, you look at some of these lending platforms which have a proprietary token, and the value of that token is a function of the cash flows deriving from fees on that lending platform. You can conduct a valuation of that, right? Mm-hmm. And then there's an incentive to increase the usage of the lending platform in order to drive up the implied kind of annualized cash flows and drive up those valuations. And it seems, and then if you look at the actual what's driving the usage of these lending platforms, it's these airdrops or the yield farming of these novel governance tokens that are governance or possibly something else tokens that are being inserted onto them, which in turn drive up the usage of the lending platform. So a lot of the valuation is predicated on usage, which is kind of entirely self-referential. It all comes back to these tokens which are being kind of airdropped to users in this novel way. So if that story is ever punctured and users lose faith in the long-term kind of value accrual potential of the token, a lot of the volume on these decentralized lending platforms will shrink back down. And so you get this positive feedback loop on the way down, which has the potential to be really aggressive and really destructive. And I don't know if investors have fully reckoned with or rationalized this yet. So it's been an exciting few months for sure. I think there's potentially a lot of retail investors that are going to lose money in relatively short order here, unfortunately. Right. That said, some of the fundamental innovations that are occurring are pretty interesting. I mean, decentralized lending facilities being the most interesting among them for me.
Yeah, if you look at a project like Chainlink, which has been popular lately, and public oracles should help make future markets even more efficient, do you think it's realistic to think that mass information can be programmatically gathered and disseminated like that?
Well, we have oracles in securities markets. They're just capital markets data companies. And their incentive to provide good data is just a reputational one, and it's a business model. They commit to serving up high quality and timely data under a service level agreement, and that's what they do. And I'm the co-founder of a data company in crypto, Coinmetrics, and they have similar service level agreements with enterprise buyers to provide financial market data to them under service level agreements, so they're liable if they fail to do this. Now, if you compare that with something like Chainlink, where you have this kind of centralized network of entities that are injecting data into smart contracts, we've seen failures there. We've seen those contracts fail to be updated for hours at a time. It's hard to rely on kind of a decentralized ecosystem of validators or nodes. It seems like a nice idea. I think in practice, we've seen some of those failures already, even at the incipient size. A lot of the energy is premised on the value of the token, which is obviously volatile. We don't know what that's going to be in the long term. So this is kind of a boring position to take, but I think the best oracles are just firms which specialize in data provision and are happy to sign up to an agreement with a buyer to provide that data in a kind of timely and orderly fashion, and do that under a service level agreement. That's worked just fine in much larger markets for decades now. So
Right.
I don't really see why we need a decentralized version of that. This seems like a solved problem. And certainly, I'm generally against the creation of spurious tokens. I don't really see where the valuation derives from in that case. So, not to pick on Chainlink specifically, but to me, this is not something you strictly need a blockchain for. I'm pretty happy with strategic re-centralization. I don't see why a private company couldn't inject that same data onto a blockchain without the use of a token.
Mm-hmm. Yeah, very interesting. So are there any projects that you're particularly excited about right now?
Well, I'm excited about the prospects for Taproot activation and Schnorr signatures on Bitcoin. I think that's going to dramatically increase the efficiency of the usage of the chain, which has been a big theme for the last few years. And that's going to allow us to weather another bull run without fee pressure getting too significant. So that's something I'm keeping my eye on. I've been looking at Jeremy Rubin's check template verify project, which will add some more potential sort of smart contracting functionalities to Bitcoin. You can already do quote unquote smart contracts with Bitcoin, but adding covenants to Bitcoin would be pretty compelling, pretty interesting. And honestly, I think it's about getting the boring stuff right. Building up in a layered approach, facilitating inter-exchange settlement. So I think Liquid is going to have a good 12 months here. I think it makes sense for a certain class of transactions to move onto Liquid. Transactions which require privacy. They have their confidential assets protocol on there. Larger transactions between exchanges that effectively trust each other. They don't necessarily need to touch the main chain. So you could see it develop into kind of a clearing network. I think as the fee pressure on the base chain grows, the incentive to move off chain or near chain to things like Liquid and Lightning is going to grow, and I think their prospects are pretty bright here.
Great. Well, thanks so much for being with us today.